Should you choose short or long P2P lending loan terms? Imagine having the power to decide how long your money stays invested and how much you earn. That's what choosing between short and long peer-to-peer lending terms is all about. When you evaluate these options, think about what matters most to your passive income goals. Short-term loans usually last from about 30 days up to 1 year. They give you quick access to your money once the loan matures. This means you can reinvest sooner, especially if interest rates go up or if you spot new opportunities. Short-term loans also tend to have lower risk of borrower default because you're not tied up for long periods. Plus, if the platform offers a secondary market, you might be able to sell your loans before they end. But keep in mind, these loans often pay lower interest rates than longer ones. The reason is lenders want a higher return for locking their money away for a longer time. Also, if you can't find new loans to reinvest in, your money might sit idle, which could cut into your overall returns. Long-term loans usually stretch beyond 1 year, sometimes up to 3 or more. They often come with higher interest rates, which means more income if you're willing to keep your money invested longer. These loans are good if you prefer steady income without constantly checking your investments. You won't need to reinvest as often, saving you time and effort. However, your cash is locked in for a longer period, making it harder to respond to market changes or emergencies. There's also a higher chance of borrower default risk over time, especially if the borrower's financial situation worsens. But if the platform has strong borrower screening, this risk can be minimized. From a passive income point of view, short-term loans work well if you want flexibility and quick access to your funds. They're good for building an emergency fund or taking advantage of changing interest rates. Long-term loans are better if you want higher yields and stable, predictable income. They suit investors who don't want to constantly manage their portfolio. Many investors choose a mix of both to balance risk, returns, and liquidity. This way, they can enjoy the benefits of higher interest rates from long-term loans while keeping some funds in short-term loans for quick access. Always check the specific platform's offerings, fees, and secondary market options, as these can influence how easily you can exit your investments early. In the end, your choice depends on what you value most: quick access and flexibility or higher, more stable income. Both options have their strengths, so think about your passive income goals, how much risk you're comfortable with, and how soon you might need your money back.